Today we're going to do a quick analysis of Roblox because a subscriber requested it. So that's what we're going to do today. So Roblox, they are basically a gaming platform, kind of like Minecraft, where people can make their own like servers or games or whatever, and people play them. Yeah, so there's kind of some variety, but really you're running around with like this Lego block guy. But yeah, it's so weird that this is an actual company, but yeah, here's the 5-year chart. They IPO'd March 7th of 2021, it looks like. And they're down quite a bit from their IPO. Usually this happens with IPOs. Like you normally want to stay away from IPOs because a lot of times it's just a way for the initial owners to unload their shares and exit the position. So yeah, usually you want to stay away from them. But we're coming up on like the 3-year mark that this company's been public. And so maybe it is a good time to buy, since most likely all the insiders have exited their positions, and now maybe you're getting a fair price. So let's take a look here. The market cap is 21 billion for this game, which is kind of crazy, especially when they're not making any money. Yeah, let's take a closer look here at the financials. And they have good revenue growth, like yeah, really solid revenue growth. They even grew 25% last year, which is really good. 22% last quarter. However, their revenue is quite low compared to their current market cap. So 2.8 billion in revenue compared to 20 billion in market cap is, yeah, that's a pretty high price of sales. But yeah, they don't make any money. They actually don't really have that high of a gross margin either. And then yeah, they spend a lot on whatever this is. Maybe marketing, maybe it's just administration. Oh, they've got to pay all the people coding for them. So they've got research and development here that takes a lot of money. So that's going to be their coders. And then we've got, yeah, their income is negative, and they issued quite a few shares, so they diluted shareholders to pay for it. And balance sheets, the balance sheet is very, very good. Negative net debt, so very good balance sheet. Cash flow, well, yeah, they're just issuing shares, so they don't really do much with their cash flow. In terms of stats, let's look here. Their return on invested capital is negative because they have negative margins. Their gross margin is like 20%. Yeah, it's about 20%, 24% last quarter. But yeah, I'd say like between 16 and 20. Then their net margin is negative 40%, so it's actually gotten worse since they IPO'd. That's not really a good sign. However, you'd expect that to get better over time. So let's take a look what the analysts think. Yeah, the analysts are thinking, okay, you know what? This is what I wanted to show you guys as well. I went to the forecast page of this, and we've got 17 analysis saying strong buy, and that the highest price going up to $60. So the analysts think it's going to be an 80% gain, and literally in the next 4 years, they're expected to lose money. Like, I don't really understand how analysts come up with this price projection, but this is insane. Like, okay, at least there's some reasonable people here that say strong sell or hold. But yeah, why would you want to buy a company that's losing money? Okay, I mean, I get it that they have revenue growth, but like, it's a game company that, like, I don't really understand how this is different than Minecraft. Like, Minecraft grew, and then it's basically been pretty stagnant game, like, for a while. It basically saturated the market, and now it's done growing. And I don't know how this is different from Minecraft. I mean, honestly. Anyway, let's take a look at the Yahoo analysts think. Well, we're looking at negative earnings. So basically, when we do our model, we're going to have to use a revenue and margins model. But yeah, we've got revenue of 4 billion going up to 4.8. So they're thinking a 20% increase into 2025 and a 16% increase this year. So pretty solid revenue growth. And yeah, maybe that stays steady. Maybe they get it right. Maybe they get it wrong. But usually we use the analysts for those projections. Let's look at the stats. Their short percentage is 5%. That is a red flag. Normally, if it's 5%, you don't want to touch the stock. Yeah. usually a good idea to take a look at short percentage. You can because a lot of times people that short a stock know what they're doing, because shorting stock is quite risky. Okay, let's look at the model I have on these guys, and I tried making it pretty optimistic. So here we go. I put the revenue estimate. We're not going to ignore the earnings estimate. We're going to use this one. Okay. So here we've got the revenue estimate. They don't do any buybacks. Their net debt is negative, so that's good. Discount rate of 10% and exit multiple of 18. Yeah, I feel like the growth is going to slow, and I don't see the moat in this business, so I think an exit multiple of 18 is fair. Yeah, I think that's fair. So for revenue growth, the analysts are projecting 19% into 2025, so that's what I'm using, and then just slowly steadying off to down to 7%, because usually it's pretty difficult to grow at a 20% clip year after year after year after year. Usually you eventually grow so big into your market that you saturate it, and then it becomes harder and harder to grow. And that's what I think is going to happen here to Roblox. So, and then this is an even more optimistic scenario, the profit margin. So they've had negative 40% last year, I think, in profit margin. So this year I'm projecting negative 20%, so that's a lot better, and negative 10%, and then negative 5%. And then they finally break even in 2027. That's what I'm projecting. And then after that, we've got a profit margin of 5%. And remember, their profit margin or their gross profit margin was like 20%, not even. So it'd be very difficult to get a profit margin up to 20%. However, that's what we're doing here. We're actually going to get it all the way up to 15%, and even 15% for the exit multiple. Or when you exit, their profit margin is going to be 15%, which honestly, I doubt that they're going to be able to do that. But if they can somehow do that, maybe I'm missing something, but if they can somehow do that, then they're worth about $20 a share. And with them trading at 33, they're currently way overpriced. Yeah. And I really don't think that they're going to hit these numbers. Maybe they'll hit the growth numbers. Like they might be able to grow at like 15% a year for a while. But they're not going to be able to hit these profit margin numbers. It's just not going to happen. And what else? Oh, yeah. Okay. Let's say that this projection plays out, then you're probably looking at a 5% return. No, even less, like a 4% return. Even less than that. Yeah. Assuming that this plays out, you're looking at like a 3% return over the next 10 years. So, well, 3% a year. Yeah. Compounded. But yeah, not very good. And yeah, I would stay away. It's still, I don't know if it's hyped up or what, but like, this company doesn't really make a lot of sense to me, to be honest. Maybe you guys know more about it than me, but yeah, the numbers don't lie, and so I will stay away. That's my opinion. Let me know what you guys think in the comments, and I'll see you in the next video.